Anthropic just launched a $1.5 billion joint venture with Blackstone and Goldman Sachs to embed Claude into portfolio companies. Used as a consortium model, group of investment firms scaling AI through economic diffusion, pushing one technology stack across hundreds of companies that they already own. On the ground, this looks like forward deployed engineers, technical staff who build and maintain AI systems directly inside a client's environment. That's necessary because model capabilities change on weekly or monthly cycles, and a one time installation goes stale quickly. These engineers solve two problems, which is system context, connecting Claude to the specific data, tools, and rules around each task, and workflow ownership, making sure AI runs complete business processes end to end, not just isolated tasks. Instead of rebuilding from scratch every time the model updates, they keep the system evolving from day one, adapting to new model weights without manual reconstruction. Now, the private equity side. From 2020 to 2022, many PE funds bought companies with near zero interest rates, around 0 to 1%, and paid 20 to 30 times annual earnings. These funds run on a 10-year clock, first years to buy, middle years to improve, and final years to sell and return cash. With rates now several points higher, debt is more expensive and exit prices are lower. Many of these deals are underperforming at their original targets. In this environment, Anthropic is estimated to hold roughly 73% of enterprise AI spend, with OpenAI at about 26%. To lock in captive customer bases, users tied to one ecosystem, OpenAI is offering PE firms a 17.5% guaranteed minimum return, despite about $30 billion in annual operating losses. That gap between promised yield and current cash flow implies a heavy reliance on future valuation and equity, not current earnings. For workers, productivity gains from AI are often captured as margin, profit for owners because PE funds must hit specific return targets within that 10-year window. At the same time, a liability gap remains. AI labs generally do not assume responsibility for model errors, so legal and professional risk stays with humans using these tools. Anthropic's valuation has increased around 15-fold in 12 months from $61 billion to roughly $900 billion. And both Anthropic and OpenAI are aiming at fourth quarter 2026 IPOs. If that happens, it will mark a shift. AI deployment and technical services move in-house to capital owners, displacing traditional consulting models and hardwiring AI into the financial logic of PE funds and public markets.